All right, folks, today we're diving deep into the fascinating world of capital investments and capital allocation. Imagine you're steering a massive ship. That ship is the company. The decisions you make about where to invest your resources are like choosing the right course to avoid icebergs and reach your destination efficiently. In other words, capital investments keep the company moving forward, while capital allocation ensures you're making the best use of your limited resources to maximize returns and minimize risks. As Level 1 CFA candidates, it's critical that you not only understand these concepts, but also remember the key principles that govern them. Think of this session as a roadmap that will guide you through both your exam and your future career. Capital investments come in all shapes and sizes, but at the core, they're about either keeping the business running smoothly or helping it grow. Imagine a factory that makes cars. Some investments might be to replace old machinery to maintain production, while others could be to develop a new electric vehicle to stay ahead of the competition. These investments are what keep the business thriving, both now and in the future. Let's get into the four main types of capital projects. These categories help us understand the different goals companies have when they decide to invest their money. Going concern projects. These are all about maintenance. Think about a factory replacing its old conveyor belts or upgrading to energy-efficient lighting. These projects don't necessarily bring in more revenue, but they're essential for keeping things running efficiently. They're like changing the oil in your car. Might not be exciting, but you definitely need to do it. Regulatory or compliance projects. Now imagine that same factory is required by the government to install a new air filtration system to reduce pollution. This is a regulatory or compliance project. These projects might not add to the bottom line directly, but they're necessary to keep the factory operating legally and safely. A real-world example? Volkswagen had to spend billions on compliance-related upgrades after the diesel emissions scandal. Expansion projects. Here's where things start to get exciting. Expansion projects are all about growth, like that factory deciding to double its production line to meet increasing demand for electric vehicles. These projects are riskier but can lead to significant rewards. Tesla, for instance, has continually expanded its gigafactories worldwide to meet the growing demand for its cars. But these moves come with risks such as delays, cost overruns, and the challenge of integrating new production lines with existing operations. Other projects, these are the wild cards, high-risk, high-reward ventures. Maybe that car factory decides to invest in developing a completely new type of battery technology that could revolutionize the industry. These projects can be hard to analyze using standard methods and carry a lot of uncertainty. They're like a moonshot. If they succeed, the rewards can be astronomical. Google's investment in self-driving technology through Waymo is a great example. It's a high-risk project, but if successful, it could transform the entire automotive industry. Let's zoom in on those first two categories, going concern projects and regulatory compliance projects. These projects are about keeping the business stable and ensuring it operates within the legal framework. Going concern projects. These are usually straightforward. They involve replacing outdated equipment or upgrading existing facilities to maintain efficiency. For instance, a utility company might replace old power lines to reduce outages and improve reliability. These projects don't usually generate new revenue, but help maintain current operations smoothly. Financing for these projects often aligns with the lifespan of the asset. For example, if you're installing a new turbine with a 20-year lifespan, you might finance it with a 20-year loan. Why? Because if the asset and liability don't match up, the company could face increased risk of default and higher capital costs. Regulatory or compliance projects. These are projects that a company must undertake to comply with laws, regulations, or safety standards. They might be costly, and in some cases, a company might decide to shut down part of its operations if the cost of compliance is too high. For example, some older coal plants in the US were closed rather than retrofitted to meet new environmental regulations because the cost was simply too prohibitive. Now, let's get into the more dynamic side of things, expansion projects. These are projects that help the company grow, whether by adding new products, expanding into new markets, or acquiring other businesses. These projects involve more uncertainty, time, and capital compared to replacement projects. Let's say a retail chain decides to open stores in a new country. This is an expansion project. The company has to conduct detailed market research, understand local consumer behavior, and deal with potential risks, such as political instability or currency fluctuations. Walmart's expansion into India, for example, has been a long and complex process involving careful analysis of local market conditions, regulations, and consumer preferences. New lines of business and other projects. These investments often involve stepping into uncharted territory. For example, Amazon's decision to enter the cloud computing business with AWS was a bold move. At the time, it was a high-risk project, but it has since become one of Amazon's most profitable divisions. These projects are often driven by visionary leadership and can lead to significant growth if successful. All right, so how do companies decide which projects to invest in? That's where the capital allocation process comes in. It's all about making smart decisions to maximize returns while managing risk. Imagine you're a manager at a large corporation. You've got a bunch of investment ideas on your desk. How do you choose which ones to fund? Here's a typical process: idea generation. This is where the magic starts. Ideas can come from anywhere: top management, department heads, or even outside the company. The key is to understand the competitive landscape and the firm's current operations. A great example is 3M, a company known for encouraging innovation across all levels, leading to the development of products like Post-it notes and Scotch tape. Investment analysis. Once an idea is on the table, the next step is to crunch the numbers. This involves forecasting cash flows, assessing risks, and evaluating the project from all angles. For instance, before Apple decided to launch the iPhone, it would have analyzed the potential market size, production costs, and expected revenues very carefully. The goal here is to determine if the project will generate a positive return on investment. Planning and prioritization. Here, managers prioritize projects based on their potential to deliver risk-adjusted returns. This is where you separate the winners from the losers. For example, Google might have dozens of potential projects, but it only funds those that are expected to generate significant returns. Think about their focus on AI and cloud computing today. Monitoring and post-investment review. After the investment is made, it's crucial to monitor its performance. If the project isn't delivering as expected, adjustments need to be made. This step is all about learning and improving future capital allocation decisions. A real-world example is General Electric, which had to divest several businesses after realizing they weren't meeting performance expectations. Analytical tools in investment analysis. To evaluate potential investments, companies rely on tools like net present value, NPV, and internal rate of return, IRR. Let's break these down with some more detail. NPV, net present value. NPV is the present value of all expected cash flows from an investment minus the initial investment. Think of it as calculating the true worth of a project in today's dollars. If NPV is positive, the project is expected to generate more value than it costs, making it a good investment. For example, if a company is considering building a new factory, they'd calculate the NPV of the expected future cash flows from the factory against the initial construction cost. If the NPV is positive, they should go ahead with the project. IRR, internal rate of return. IRR is the discount rate that makes the NPV of an investment equal to 0. It's the break-even rate of return. If the IRR is higher than the required rate of return, the project is generally considered a good investment. A company like Tesla might use IRR to evaluate the profitability of building a new gigafactory. But remember, IRR assumes that all interim cash flows are reinvested at the IRR, which might not always be realistic. In practice, NPV is often considered more reliable, especially for projects with unconventional cash flow patterns. Return on invested capital, ROIC. Another critical metric is ROIC. This measures the return generated on a company's invested capital and is crucial for assessing how efficiently a company is using its capital to generate profits. ROIC is especially useful because it can be calculated using publicly available data, like consolidated financial statements. This makes it a favorite among analysts. For example, if you're analyzing a company like Apple, you might look at its ROIC to determine how well it's using its capital compared to its competitors. If Apple's ROIC is significantly higher than its required rate of return, it suggests the company is generating excess returns, a positive sign for investors. However, remember that ROIC is based on accounting data, which can be influenced by accounting conventions. It's also backward-looking, meaning it reflects past performance rather than future potential. So while it's a useful metric, it should be used alongside forward-looking measures like NPV and IRR. When it comes to capital allocation, there are a few principles that companies should always keep in mind. Focus on after-tax cash flows. Decisions should be based on after-tax cash flows, not just profit or accounting metrics. This means considering the impact of taxes on cash flows, including tax benefits from non-cash deductions like depreciation. For instance, when a company like ExxonMobil evaluates a new oil project, it considers after-tax cash flows to determine the project's viability. Consider incremental cash flows only, but look broadly. Companies should focus on the incremental cash flows associated with a new investment, excluding sunk costs. But they also need to recognize both the positive and negative impacts on the rest of the firm. For example, if Coca-Cola launches a new product, it needs to consider how this will affect its existing product lines. Will it cannibalize sales or create new opportunities? Timing of cash flows. The timing of cash flows is crucial. Companies should examine the projected time duration, volatility, and changes in expected cash flows. Timing can significantly affect the NPV and IRR of a project. For example, the timing of cash flows in real estate projects can be critical. If a project is delayed, the cost can increase, and the expected returns can decrease. But even with these principles in mind, there are pitfalls to avoid. Cognitive errors. Management might make forecasting errors, overlook the cost of internal financing, or ignore inflation's impact. These errors can lead to poor investment decisions. For instance, during the 2008 financial crisis, many companies underestimated the impact of declining real estate values, leading to significant losses. Behavioral biases. Managers might stick to the status quo out of inertia, favor pet projects without proper analysis, or fail to consider alternative scenarios. These biases can result in suboptimal capital allocation. For example, Kodak's failure to fully embrace digital photography due to its focus on its legacy film business is a classic example of behavioral bias leading to poor capital allocation. Real options. Finally, let's talk about real options. These are options that give managers the flexibility to make decisions in the future that could impact the value of investments made today. Real options are similar to financial options, but instead of dealing with stocks or bonds, they deal with real assets like factories, patents, or even entire businesses. Real options come in different forms, and here are a few examples. Timing options. Imagine you're an oil company deciding whether to drill a new well. A timing option might allow you to delay the investment until oil prices are higher, maximizing your returns. Sizing options. These include the option to expand or abandon a project based on future performance. For example, a tech company might start small with a new product line and expand it if the initial sales are strong. Conversely, if the product doesn't take off, the company might choose to abandon it and cut its losses. Flexibility options. These options allow a company to adjust its operations in response to changing market conditions. For instance, if a car manufacturer sees a sudden increase in demand for electric vehicles, it might have the flexibility to shift more production capacity to EVs. Fundamental options. These are options where the entire project is contingent on external factors. For example, a mining company might have the option to start or stop production based on the fluctuating prices of minerals. If prices are high, it makes sense to produce more. If prices drop, the company might scale back or halt operations altogether. Evaluating projects with real options can be complex, but it's essential for making informed capital allocation decisions. Real options add a layer of flexibility and responsiveness that can significantly enhance the value of a project. To wrap things up, capital investments and capital allocation are critical components of a company's long-term strategy. Understanding these concepts and how to apply them is key to making smart investment decisions that maximize returns while managing risk. Remember, as future CFA charter holders, mastering these principles will not only help you in your exams, but also in your professional careers. So keep practicing those examples from the CFA Institute's curriculum and from FinQuiz question bank and stay sharp.